to stick to what we have been saying for a long time now, which is that soft landing narrative. At least it is up until now. Like this morning's, as you were pointing out, this morning's two reports, the ISM was up and the jolts were down, job openings were down. So but it's not down enough. We still have over 1.4 jobs available for every unemployed American out there. So that's a pretty decent job market overall. We're not seeing, 2 jobs for every one person like we did, last year, but it's still a tight labor market and it's still fairly healthy. ISM services, showing that activity is picking up the most in a couple of months. I mean, this is only the first increase in a few months, but still it shows that, again, this whole soft landing narrative is still playing out, at least for now.
Looking at the ECFC function in the terminal, you can pull up, looking at where the consensus among economists that are pulled in the terminal, you can look at annually, also quarterly. If you look over quarterly, though, on a basis, there no longer is a quarter-over-quarter contraction coming into this year. Originally, there was a call for the second and third quarter to see contraction. We aren't seeing that anymore. We're still seeing growth. So I'm curious your thoughts on when there still is this concern, because looking at how the consensus among economists, the probability of a recession is still around 50%. That's pretty elevated compared to if you're looking at, say, other firms like Goldman Sachs that have lowered their calls in recent months. Why do you think there is still so much skepticism and gloominess out there about the trajectory of the economy when you have this juxtaposed against a lot of really strong consumer spending data?
I think it's a great question, and I'm thinking that we've never been in this sort of environment where we have a central bank like the Fed that has been tightening so much in such a short amount of time. This is like a record amount, and yet we're still seeing business investment. It has its ups and downs, of course, but it's still supported by fiscal spending, and it all goes back to the U.S. consumer staying resilient. They're not going to be spending like crazy, in coming months. I think things have already started to dial down, but again, it's that job market. I think it all goes back to having a strong job market, and that goes back to demographics. It goes back to the pandemic. What I was a little bit worried about, I will say, was when I saw the personal income and spending data last week with that very small 0.1% wages and salary increase. And I was like, oh, that's not great. But, it's good in terms for the Fed, but it's not great for the consumer. But as long as, we continue to see steady job growth, continue to see steady wage gains, either 0.1 or 0.5 or whatever, I think that will be a good support system overall for the U.S. economy. Now, we actually polled, by the way, our negative growth rate quite a while ago, and I'm losing track of time here in my old age. But we have pulled it, and again, we're sticking to that soft landing. So we've got growth slowing from that unsustainable, I think, 5.2% growth rate in Q3 down to about 1% in Q4, and then flattening out a little bit around the 0.2s or so over the next first half of next year. But
Jennifer,
again,
Jennifer, talk to us about inflation here. I don't know. I mean, for John Tucker and I, it's all about filling up our cars with gasoline down at the Jersey Shore. And I just filled up for $3.10 a gallon. I feel like inflation's coming down, but I'm guessing the Fed doesn't gauge it on my gasoline intake here. But so how do you think the Fed is viewing inflation and the fight against inflation?
I think it's viewing it with a very cautious outlook. And even though, for example, like last week when Governor Waller introduced the whole concept of rate cuts into the whole conversation, which everyone got super excited about, he didn't, he just said that that was he was encouraged by that number. And it needs, I think he said 3, 4, 5 months before they can start talking about rate cuts. So he didn't even mention that they're going to start cutting rates. He says we need to see a few more months worth of better inflation data before we do anything. So I think they're viewing it with a very cautious outlook. But again, when we have longer term inflationary pressures out there, like from the labor market, we have the working age population globally has already basically peaked, right? So we're seeing a lot of people retiring, a lot of people shifting industries. So there's still that tightness in the labor market. And this is again, a global phenomenon, and certainly that in the US. I think Bloomberg ran a story this morning about nurses being, in short supply as another example of an industry that needs workers. So that's going to cause upward pressure on wages and the labor market. And then I'm going to point to Mother Nature again and climate. That's been causing so much havoc all over the world in terms of floods and droughts. And I think that's going to have, some still upward pressure on food prices and all that. And of course, all the wars are having upward pressure on energy prices. So all that, I think, still has, I'm a bit worried still about inflation. I'm not going to call it an all clear just yet. And I think the Fed would probably agree.
On Friday's jobs report, we'll also get a reading on average hourly earnings. What are you seeing when it comes to wage growth? Because that is something that we know Fed Chair Jerome Powell is watching really closely.
Mm-hmm. So we're looking for about a 0.3 increase, which is in line with consensus, about 4% year over year. Still steady, but coming down. I mean, because we already know that the economy is slowing. It's not 5.2% anymore. It's probably closer to 1% this quarter. Demand is starting to slow. We're not seeing, 300,000 job increases anymore. So I think wage demands and the fact that inflation, as we just said, is coming down, I think is going to temper demand for earnings. Now, having said that, I'm also a bit concerned just given all the strikes that we've seen over the past year. And I don't remember a time where we saw so many and demands were being met. So that, again, is sort of like that, on the one hand, on the other hand thing, which I shouldn't be doing, but I'm doing it anyway. Overall slowing demand for labor. But still, there's still that big source overall. So I think it's still going to be steady-ish, but slower wage growth overall.
Jennifer, outside of the U.S., where are you kind of focusing on? Where's the big delta? Is it Europe? Is it Asia? Outside the U.S., where are you focusing?
I'm kind of worried about Europe, frankly, but although this morning I will say that I was a little bit more relieved. It was like and we normally don't look at revisions too much for services and composite PMIs because they usually don't change that much. But the fact that they all were revised higher, particularly in the UK as well, back over 50, was a little bit gratifying. And the fact that that last week's inflation rate for the euro area, the lowest in over 2 years actually, and the fact that one of the big Uber hawks herself, Isabel Schnabel, of the vice executive board member of the ECB, actually said that when things change, she changes her mind, and that's I think huge. Coming from her, some of the other hawks, from the Bundesbank, and we haven't heard from Austria recently, but I think they're still very more cautious on the outlook. But I'm still, again, worried about when the ECB will finally drop its hawkish talons. And of course, they still are surrounded by wars over there as well. So that's a little bit worrying. And of course, the UK is actually interesting. The data keep changing. A lot of revisions out there that, and we're seeing a lot of signs changing on growth rates, which is kind of interesting. But the UK is not looking as bad as I would have expected a year ago. So I'm a bit more encouraged on that front.